It's no secret that it's a good idea to start investing. But one thing I see people forget time and time again is the tax implications. And here's the thing, the ATO doesn't take too kindly to those that submit incorrect tax returns, leading to audits and in some cases hefty fines. But the good news is this is all very avoidable. So in this video, let's talk through the 7 investing red flags the ATO will be on the lookout for in the year ahead. And at the end of the video, I'll show you a simple, powerful move you can make that solves all of these problems. Let me tell you something I've learned from analyzing billions of dollars worth of investment data on the portfolio tracking platform I built. The truth is, most investors have no idea just how close they are to messing up their tax. But it's not because they're making big mistakes or anything. Usually it's just because the system they're using is complex and messy. Brokers don't talk to each other, CSVs break, ETF statements don't make sense, and then the ATO, who sets these endlessly complex rules, has the audacity to hand out big fines when we inevitably slip up. So what I'm about to tell you aren't small mistakes. These are the exact things that trigger audits, amendments, penalties, and a whole lot of wasted time. Get ahead of them now and tax time becomes super easy. Ignore them and you learn the hard way. The biggest mistake I see, and the one that trips up more Australians than anything else, is misreporting ETF distributions. And the reason it's so dangerous is because it looks simple, but as they say, looks can be deceiving. Yes, your tax return gets pre-filled with distribution data straight from the ETF provider, but here's the thing. People see that and incorrectly assume the ATO's system is 100% accurate. But that's the trap. The ATO only pre-fills the income component. They don't pre-fill the AMIT cost base adjustments. And this is the part that actually changes your cost base and affects your capital gains or losses when you sell. So what is an AMIT cost base adjustment? It's the fund's way of reconciling the difference between what the ETF attributes to you for tax purposes and what you actually receive during the year. Because ETFs are structured as trusts, you are taxed on the income the fund attributes to you, which can include things like interest, dividends, capital gains, and other components, not just the cash that lands in your account. So if the ETF attributes more taxable income than cash, your cost base gets increased, so you don't get taxed twice when you sell. If it attributes less taxable income than cash, your cost base gets reduced. But here's the thing, tracking those numbers is on you. You have to track it yourself, and most investors don't even know it exists. And here's the part that nobody tells you. This affects every ETF in Australia. If you own an ETF, any ETF, you're getting these adjustments every single year. So if you've had an ETF for more than one tax cycle and you've never heard of cost-based adjustments, then you're not maybe missing them. You are guaranteed missing them. So what happens? Year after year, you ignore those adjustments. On paper, your income looks right, but your cost base is quietly drifting further and further away from where it should be. Then one day you sell some or all of that ETF. You plug the numbers into your tax return, thinking you've done everything correctly, but your capital gain is wrong because the cost base you used never reflected those adjustments. And this is where the red flag comes in. If the ATO reviews your return and checks your capital gains against how the cost base should roughly look based on the distributions and adjustments over the years, your figures won't stack up. Not because you tried to game the system, but because you never kept the cost base in sync with reality. To make it even messier, you're allowed to calculate capital gains using different methods. Like FIFO. The ATO doesn't care which method you pick, but they do care that whichever method you do use, your cost base is correct. When it's not, your gain or loss calculation is flat out wrong. And that's when the red flag gets triggered. This is why ETF investors get caught out so often. The system creates a false sense of security, the pre-filled data looks neat and tidy, while the part that actually drives your capital gains is left for you to manage on your own. The second red flag is brutally common, and it shows up every single tax season. Missing capital gains from sales. So people buy an investment and they sell it, and then somehow the gain or loss never makes it into the tax return. And it's not because they're trying to hide anything. I mean, some people might be trying to hide something, but most of the time, it's just the chaos of modern investing. Here's the part most people don't realize. Capital gains are not pre-filled on your tax return. And that's not an oversight by the ATO, that's by design. The ATO doesn't pre-fill your capital gains because you are allowed to choose how you calculate them. Methods like FIFO, LIFO, minimize gain, maximize gain. The ATO doesn't know which method you used, so they don't assume it on your behalf. That responsibility sits entirely with you. Now add on top, investors switch brokers constantly. ComSec to Stake, Stake to IBKR, then to Self-Wealth. And every time you switch, your cost bases, your parcel history, your trade records, none of that moves with you automatically. So one missing CSV upload, one correct import, one trade buried in your email, and suddenly your tax return is missing an entire sell event. And here's where people really get caught. Selling part of a position is still a taxable event. So if you sell 5 shares out of 100, that's a capital gains event. If you sell 20% of an ETF, still a capital gains event. But most people don't remember every partial sell they've ever done, especially after a year of tiny DCA trades cluttering the history. So what happens? You submit your return with incomplete sell data, and now the ATO's version of your trading history doesn't line up with the one you reported. They get your buy and sell feeds directly from the brokers. And if your return shows fewer sells than their records, that's an instant question mark. Missing even one sell, even a tiny one, throws your capital gain calculation completely off. And once the ATO sees a mismatch in your sell data, they start wondering what else is wrong. The next red flag is sneaky because it looks harmless. DRPs, or dividend reinvestment plans. On paper, it's simple. You get a dividend, the broker uses it to buy more units, and your position grows automatically. Easy. But DRPs are one of the biggest silent killers of accurate tax records because most investors don't record them properly. Here's what actually happens. A DRP is a purchase, not a bonus, not a freebie, a literal buy trade. It creates a new parcel with its own cost base, its own date, and its own impact on your future capital gains calculation. But most investors either forget to record the DRP altogether, or they don't even realize they need to track it in the first place. And there's another part that catches people completely off guard. Even though you never receive the cash, you still pay income tax as if you did. That dividend is treated exactly the same as if it landed in your bank account. Except instead of you choosing what to buy with it, the broker buys more units for you. So if you ignore DRPs because nothing hit my account, you're already behind. And if that DRP happened on an ETF, now you've also got annual cost-based adjustments applying to every single one of those tiny parcels. So not only do you have dozens of micro purchases to keep track of, each one has its cost base shifting every year whether you notice it or not. So you end up with cost bases that don't add up, parcel lists that don't match reality, and dozens of tiny purchases scattered across years of statements. And you won't notice the problem until you go to sell. Because when you sell even a small portion, the system needs to know exactly which parcels you're selling from. If the DRPs are missing or never recorded, your capital gain is wrong. And just like the other red flags, this isn't about intent, it's about complexity. DRPs stack up slowly over time. A few dollars here, a few dollars there. After a couple of years, you're sitting on 20 or 30 or 40 mini purchases you never tracked. Then tax time rolls around and your spreadsheet, if you even have one, doesn't match the actual history at all. When the ATO looks at your numbers, they expect your cost base and your parcels to reflect every DRP purchase. If they don't, your capital gains calculation won't line up. And that is when the questions start. If you've touched crypto at all, even once, this is one of the fastest ways to trigger an ATO red flag. And the reason is simple. Crypto has taxable events that look nothing like traditional investing. So most people don't even realize they're meant to track them. The biggest trap I see is coin swaps. In crypto, swapping one coin for another feels like a simple trade inside the app, but the ATO treats it as a full disposal. Every swap is a capital gains tax event. And if you've done dozens of them without recording cost bases, your numbers are already off. Then you've got staking rewards. People assume it's not cash, it's just tokens appearing in my wallet. But the ATO counts that as income on the exact day you receive it. If you're not logging the amount and the market value, at that exact moment, you're missing taxable income in your return. And here's the part nobody sees coming. The fees you pay on wallet transfers can also trigger a capital gains event. So if you pay a fee using a token that has a cost base, like Ethereum or Solana, you've technically disposed of that token, another CGT event. And another thing most people never track. All of this gets worse because crypto activity is scattered everywhere. You've got exchanges, wallets, DeFi platforms, hardware devices, random apps. None of them are talking to each other. One lost CSV, one forgotten wallet, one exchange shutting down, and your entire crypto history has gaps. Meanwhile, The ATO isn't in the dark. They get data directly from exchanges and use blockchain analytics to map wallet activity. So when your tax return leaves out swaps, staking income, or fee disposals, those mismatches stand out immediately. Crypto gives you more ways to make money and way more ways to accidentally misreport it. And that's why it's such a high priority red flag for the ATO. This next red flag looks harmless on the surface: switching brokers. Everyone does it. You start with ComSec, you move to Stake for cheaper trades, jump to IBKR for global markets, then you open a superhero account or a self-wealth account because the app looks clean. It's normal. But every time you switch brokers, you create a perfect storm for broken tax records. And here's the part most investors don't realize. Your full trade history gets reported to the ATO by every regulated broker, thanks to anti-money laundering laws and data matching laws. And that means the ATO can see your entire sequence of buys and sells across every platform you've ever used. But when you switch brokers, your history doesn't move with you. The parcels, the buy dates, the cost bases, the DRPs, none of that automatically transfers with you. All the new broker sees is what you're holding today, not how you got there. So now you're relying on CSV files to stitch the past together. And CSVs are one of the biggest sources of tax errors in Australia. Missing rows, wrong timestamps, duplicated trades, partial exports, formatting differences between brokers, one broken file, or one unchecked box. Suddenly your version of your history is not the same as the version the ATO already has. And if you try to clean it up in a spreadsheet, good luck. One bad formula, one accidental sort, one misaligned row, and your cost bases drift away from reality without you even noticing. And this is the actual red flag. If the trades in your tax return don't match the trades the ATO already received directly from your brokers, even by a single transaction, that discrepancy stands out immediately. Your tax return is judged against their version, not your spreadsheet. And most people think switching brokers is just a UI upgrade or cheaper fees. But behind the scenes, it's one of the fastest ways to break your entire trade history, because the ATO knows exactly what happened and most investors only know what they managed to export. Another major red flag is foreign income, and almost everyone underestimates how easy it is to get this wrong. The moment you buy a US stock or an international ETF, or anything that earns income from overseas, you have created a foreign income reporting obligation. Most investors have no idea because on the surface it feels exactly the same as receiving a normal dividend. But here's the part people completely miss. Foreign income is usually not pre-filled on your tax return, and that's not a glitch. That's because foreign companies, foreign brokers, and foreign tax authorities don't automatically report clean dividend and interest data to the ATO, like Australian companies do. So even though you might be holding Apple, Tesla, Microsoft, VOO, SPY, Triple Q, none of those dividends get dropped neatly into your tax return. It's 100% on you to report them. Meanwhile, US dividends come with withholding tax. International ETFs break distributions into foreign income components. Some funds pass through foreign tax credits. And all of that sits buried inside annual statements that most investors never read. And this is where the red flag happens. If you submit your tax return showing only local income and the ATO's data from International Information Exchange Agreements and ETF reporting says that you received foreign income as well, that mismatch stands out instantly. Foreign income isn't that hard to report, but because it's not pre-filled and because it doesn't look foreign when it lands in your bank account, most people miss it entirely. And that's exactly why the ATO pays attention to it. This last red flag is the one almost every long-term investor gets caught out by, and it has nothing to do with doing anything wrong. It's the simple math of dollar cost averaging. Every time you DCA, every weekly buy, every fortnightly buy, every automatic contribution, you're creating a brand new parcel with its own cost base and its own timestamp. If you do that for a year, you've already got 20 to 50 parcels. Do it for 5 years and you're sitting on hundreds. Do it across multiple ETFs or stocks, and now you're into the thousands of parcels. And here's what almost nobody realizes. Your capital gains calculation depends on every single one of those parcels being tracked perfectly, down to the cent, for years. Which parcel was purchased first? Which one was sold first? Which ones have fees applied? Which ones have a cost-based adjustment? Your CGT outcome changes depending on the exact order. This is where DCA becomes a hidden time bomb, because the more parcels you create, the higher the probability that one or two are missing, misdated, mispriced, duplicated, or simply wrong. And when even a single parcel is off, your entire cost base, and therefore your capital gain, is completely wrong. And the ATO doesn't see your spreadsheet, they see the final number that you report. If that number doesn't line up with what your cost base should have been after years of DCA activity, that discrepancy stands out. Long-term investors often don't realize this, but after a few years of DCA, most portfolios contain cost base errors that have been building quietly in the background, and they only show up, annoyingly, when it's time to calculate capital gains. So here's the truth behind all 7 red flags. They're not actually 7 different problems. They all come from one problem. Your investment data is split across a dozen places and none of them agree with each other. Your brokers each have a piece, your ETF providers have another piece, foreign companies aren't reporting anything properly, your CSV files all look different, your spreadsheet is whatever you tried to piece together from all of that, and the ATO only sees the final number you submit, not the mess behind it. When your data is inconsistent, then your tax return is inconsistent. When your records are incomplete, then your return is incomplete. And when the ATO compares what you submitted with what they received, that's where huge red flags come from. So if you want to avoid all 7 issues, the ETF adjustments, the CGT miscalculations, the missing DRPs, the crypto disposals, the broker mismatches, the foreign income gaps, the broken cost bases, you don't need 7 solutions. You need one. You need a single source of truth for your entire portfolio. One system that tracks every parcel, every cost base, every adjustment, every distribution, every tax component, every broker, and every asset automatically. That's why we built Navexa. Navexa makes tax time way easier for investors. It ensures accuracy, removes human error, fixes record-keeping problems at their root, keeping your portfolio data clean and consistent year on year. If you want to avoid the 7 red flags the ATO is watching for, stop guessing and stop hoping your spreadsheet is right. Use a system built to keep your data clean. That's Navexa. Now, I'm obviously biased, but I'm super passionate about making this system easier for investors, because the ATO certainly hasn't made it easy for us. So I'd really encourage you to try it out. You can use the platform for 14 days completely free, and if it doesn't help you with these problems, you can walk away, no questions asked. But with that said, let me know your thoughts in the comments below. And if you're new around here, consider subscribing for more down-to-earth investing information.